Well, hello, folks. I'm L.A. Little, and this is your weekly NeoTA wrap. We take a look at these markets, and we do it from a neoclassical perspective. Each time we ask ourselves what happened last week, and what does it tell us about the coming ones. I do the show every Sunday night, broadcast at or before 10 o'clock Eastern Time, archived on YouTube. It's under the channel L.A. Little. Any device, anytime, you can catch me there. Convenient and useful. As far as these markets, last week, remember, we had a nice big spike down to start the week out, but we actually finished pretty strong end of week, and as a result of that, the markets were down not that much. 1% on the S&P, 1% on the Dow, NASDAQ, and the Russell in particular outperformed. That is what we kind of thought would happen if we were going to get a bounce. And so the bounce definitely here in the Russell and the NASDAQ leading the way. That really kind of sums up what happened last week in a tight nutshell, so to speak. As far as what's happening with these markets, if we look at the S&P 500 and start with it, what you have here is you actually have volume declining as price rises, which is typically what you see after some sort of a large sell-off. You get some sort of a spike low, volume expands, then you get a pop back up. Where's this thing heading? Well, it's going back to the retest, regen. It's a bearish retest, regenerate zone. You can see it here on the TA Today charts, this red area, telling you that that's where resistance is set up. That's where you should see supply make itself available. And if so, you would think this thing would come up into this area, flip around, and actually try to head back down. And then, the question is going to be, do you get this larger ABCD structure to the downside, or do you get something different, such as this? Instead of going down, you get something like this that takes it back up higher. So we're going to have to see how that plays out. Of course, the first thing is to get up in here and fail to go higher, regenerate lower, and then we can see what that regeneration looks like on the way back down. That's the S&P 500 on the daily. If you look on the weekly itself, you have high volume lows, right, on that spike down. Trend transition here on the spike down, almost broke 2 swing points. It got down to this low but flipped around, but it did break here. It's coming back up into a retest, regenerate zone off this low, and that one actually sets up even higher. The price point there is the top of that bar. That price point would get you up to around, 1943 roughly. So you can see the setup on the weekly, on the daily, and if you look at the monthly, all this down really looks like kind of a blip on the monthly. It's really nothing registered so far, not at this point. That's the S&P 500. If we flip over and take a look at the Dow, on the Dow is the only major index that did not break on the weekly time frame. So if we look at it on the weekly, you can see here gets under the swing point low, actually closes over it. Volume does expand, but it doesn't break. And that expansion of volume down to this low is nothing compared to what it was coming into. So the Dow got a nice big spike back up. Looks to me like the Dow is trying to be the savior here, but I don't know that the Dow and the Dow 30 itself, to me, means that much. We'll see how that plays out, but that's the Dow, just so that we don't breeze right past it without really thinking about it. Now, these changes on trend, where we have transition now, that gives us a different scenario than what we've seen before. And what I mean by that is, at this point, with a trend transition, we're going to see the MTTFs reset, and we could actually see this as a good thing over the longer term. On the IXIC, the NASDAQ composite, the broad composite, now it's sold off quite a bit. Retest, regenerate zone is there, but notice these two big bars, that's the intersection here. It came into that area Friday, could not stay up there, pulled back some. This whole area is going to be tough on the way back up on the daily time frame. If we look at the weekly time frame, here we had the trend transition as well. Swing point lows there. Top of that bar is 43.95. That would be where this thing could move to on a weekly time frame. And notice here high volume lows as well. Also notice that this low got into the highs of the lows down here. The other thing you should notice is that on the NASDAQ you've got a lot of swing point lows starting to line up down here. Now I don't expect this thing to come down here immediately, but I want to have you keep that in mind as we flip over to the Russell. And what I want to show you on the Russell is what the Russell looked like on the weekly. And what I mean by that is you had a bunch of swing point lows all start to line up. Right now the Russell was extended when it hit those swing point lows, but when they line up like that, what are they doing? They're building up some sort of a large distribution area up above, and then you get back up underneath them, you're going to have a lot of resistance on the way back up. That is what happened to the Russell. It bounced first because it sold off the hardest and the fastest, but what did it do? It came right back up to do a retest regen on the daily time frame. Didn't quite get into it, got into these big bars, this whole congestion area here, flipped around, came down. I expect the Russell's going to try to crawl back up into that area, but folks, there's a lot of resistance in that area now because that was where all the distribution took place. So you can expect the Russell to struggle now after it's made its big bounce. The Russell, just like all the other indexes, has volume at the lows now. And so when you have volume at the lows, you can expect that that market is going to try to come back at some point and retest those lows. So here's the volume on the weekly at the lows as well. So index wise, if we're looking at our indexes being domestic US indexes, looks like a tough road going to set up here pretty soon. More bounce? Probably. But as it comes into those retest regenerate zones, I suspect it's going to have problems. If we look overseas, Asia, pretty tough situation. Japan selling off in a very fast and hard way. That one broke a swing point low, transition trend. Noticed all the swing point lows down here. Again, this would be extremely extended if it came straight down there, and I don't expect it to. I would expect to get some sort of a bounce, sets up some sort of a larger ABCD structure, and then tries to come down, right, and get into that area. So this area, of course, is going to be key when it finally gets down there. It's going to be more key if this thing sets up some sort of a large bounce that gets it into that area and then bounces again and then tries to break. What is important, and we're on a weekly here, what's important to realize is that this can take several weeks to take place. It's not going to happen immediately. You can think of the intermediate term time frame, the long-term time frames, is kind of like a ocean liner out there in the great, Atlantic or the Pacific. And it takes a long time to turn those things around. They don't turn on a dime. And so you kind of have to, realize that these sorts of longer term charts are not going to turn immediately. China Chinese 8 shares trades down. This is the daily, trades down under, has more volume. It's probably going to test down again as a result of that. If you look at it on the weekly, it's down here testing this swing point low, has more volume. It is testing, it's doing a retest regen on the weekly though. And so my suspicion here is that this will probably hold for now, test again, hold for now, get a bounce, and then it will try to actually regenerate lower also, or actually not regenerate lower, but go lower. And that's because of what's happening elsewhere in the world. The HSI, which is the Hong Kong index, doesn't have volume at the lows, testing, got a little volume spurt here. I suspect this one's going to try to lift. That will also probably hold the Chinese 8 shares up If you look at it on a weekly, it's tested that low. It's tested it on lighter volume. Did not hold the retest regenerate off the prior swing point high, so that's a negative. Puts it into some sort of a range trade, and I suspect that's what this is going to do. It's going to range trade back up into here in this area for a while and build out and either eventually go back up or eventually break down. Right now, those markets, Asian markets, do not look like they're going to supply the kind of support that the world markets need at this point. Looking over in Europe, the CACs, remember, it had the big blow-off bottom, just like we did, just a day later. That's the blow-off bottom. Now you get the spike up. Here you've got the same situation with retest, regenerate zones. You've got them all over the board here. This breakdown bars top, that low, that's going to be a hard spot to get over. It's probably going to try to get into them tomorrow. Looking on the weekly chart, this is the CACs as well. Comes down, breaks a swing point low, actually 3 swing point lows. That usually, because it's broken on multiple time frames and multiple swing points now, that usually says it's going to do what? It's going to try to trade sideways to down for 2 or 3 bars. So I'd expect this thing's not going to bounce too much farther. So the point there of bringing these up, of course, is that suggests that you're not going to get help in the world markets to push our markets higher. Here's the FTSE, same thing, big spike down, push back up on Friday. If you look at the weekly chart on this, you broke a bunch of swing point lows on the way down, same sort of setup. On the DAX, not quite as bad, but the same scenario. Big hammer reversal, high volume low, coming back up, going to do a retest regen off this low. This one's going to be the one that gets up higher compared to the others. And then if you look at it on the weekly, it also broke 3 swing point lows. And I don't know if you see what I see, but what this looks like to me is a large distribution area on all 3 of those charts, just like the Russell. So you're distributing stock up here at the highs. Now you've broken. If you do not get back up and stay up into this area pronto, right, over the next 2 bars, then you're probably going to see this thing trade back down again. And so Europe, yeah, can bounce a little bit more, but just like us, looks to me like all these markets, once they're done with their bounces, they're going to test back to the downside, and that's the way I would view them. So from a summary standpoint, I think that gives you kind of the general view. Just looking at the indexes around the world and the domestic ones, this market's probably going to bounce a little bit more. You got a lot of earnings this week, next week, and the following week. It's the 3 biggest weeks of the earnings season. You know, some 60-70% of the companies will report earnings these next 3 weeks. That's going to set whatever tone is set. So far, that tone has been negative. And what I mean by that is most of these earnings reports are not finding any kind of large upside, and anyone that misses or downgrades is getting hit. And so it doesn't look to me like this earnings season is going to be the kind of earnings that's needed to turn the market around. So what does that leave? Well, it probably leaves our good friend the central bankers to pick up the slack and to offer some sort of a carrot. And wouldn't you know, that's what spiked this market Thursday and Friday. It was the chatter out of the Fed officials talking about the need to maybe hold off a little bit on ending QE. Surprise, surprise, right? It's just the way it is. All right, let's turn our attention to a little bit more detail here, a little bit more color. Let's go a little deeper. First, let's go into the sectors. And I want to just look at these from a standpoint of the weekly charts. So I'm gonna pull off, as soon as I get these up and running, I'm going to pull off the dailies and concentrate on the weeklies. So we'll start with, we'll just start at the top and then work our way across. Let me pull that out of the way and we'll look at the weeklies. So here's the IBB. So the IBB comes down. IBB actually left some volume at the lows, but it was kind of a very close hammer reversal there. So, that one, if you play it extremely by the book, that says it needs to be retested at some point. But at the same time, volumes were almost equal, so I don't put quite as much weight on it. It eventually made its way all the way back to the tops. And if you look at it on the monthly chart, it actually failed at the tops, which we pointed out last week. That high was tested on lighter volume and failed. On the weekly chart, going back to it, you come off, volume expands, kind of a hammer reversal here. This looks like it's going to try and trade a little bit higher, but I think it's going to have a tough time doing so. IYT, big spike down in volume, breaks 2 swing point lows on last week's spike down. Volume expands tremendously this week. You've got all the Ebola scare that's hurting the airlines. And, this going to test lower at some point. It's just a question of how much does it bounce. Now, on this time frame, it's actually doing immediate retest regens off these swing point lows. So you can see it's right at the top of it there, trying to get back up and over that area. That's going to be the key area there. If it can get over it, it puts it into a range trade, and you can range trade that whole area. What you really want to watch as this market bounces is those areas where retest regens take place. Do they regenerate lower or not? That gives you some clue as to what's happening in the overall market if you just analyze what's happening in the individual markets, because the sectors do move the indexes in the end. Looking at the stocks very weak bounce, not much there. Volume expands at the lows. Also, these things are going to try to trade lower again at some point. XLB, same story. And you can see it on every one of these charts, which is why I wanted to show you the weeklies. Volume, extremely heavy at the lows in almost any of these charts you look at. So you've got these big spikes down, volume expands. It does hold the swing point lows, but this thing's already bearish. It can bounce up, do a retest regen off these lows, which is actually it's not this one, it's the one above it here. It's that one. And all of these have the retest regens set up. And as they come back up, some of them won't even make it to them, probably, and some will. And the ones that do are the ones to watch. XLF is another one that's got a retest regen is doing. That's this bar. Actually on the weekly it doesn't have one. It never broke. But on the daily it did, and it's trying to do a retest regen now. If you look at the XLI, big volume spikes down, retest regen. XLK, not much of a bounce there, big volume down. And you can see it right across the board. Big volume on almost any chart you look at. XLY, same thing. Even the XLV had some volume expansion to the downside. So the story on the sectors is that you are going to see some more testing. It doesn't have to come back, and this is something to note. It doesn't have to come back immediately and test those lows, but it certainly can. A lot of times that is the way it trades. But it will come back down there at some point and test them and see if they're real. See if they're going to trade lower or not. That's what the market does. That's price discovery. If I flip over to the auxiliary indexes, EEM, emerging markets, you can see the pressure being applied here. This swing point low doesn't have near the volume. This thing is going to try to test lower again. If I look at the currencies, which I'm going to pop over to the dollar, the dollar actually made that big spike high, then came off on a weekly, came off with volume, spikes down. This thing's going to bounce a little bit, but this big run up has to be worked off. And the way that usually happens, if this trend that we see is real, so in other words, this spike up, if this is a real trend that has staying power, so to speak, you're going to see this thing kind of do this gyration now and build out some sort of a range here before eventually breaking even higher. So that's the way the dollar's set up. This period here is where other things that are hurt by the dollar can actually outperform for a while it works off its excesses. If you look at the oil spikes down, leaves volume at the lows. As a matter of fact, almost any of the commodities look that way. Not any, but a few of the commodities look that way. The other side of the extreme is the TLT, where you spiked up last week. Huge spike up, a lot of short covering, a lot of people got squeezed out up here. Volume expands tremendously. Same sort of thing with volume at the lows, you're going to eventually seek them. Volume at the highs, you're eventually going to seek those too. But given the way that bar looks, it's going to be a while before you get back up there probably. Silver and gold, also commodities. Silver, very weak. Gold, not too much better. So I don't see a lot happening there. If we go over to some of the other types of bonds, like the high quality corporate bonds, big spike up. Didn't have the huge volume, but had decent volume on the spike. Municipal bonds also were being bought. Big spike up on those with volume expansion. Junk bonds, big spike down with volume expansion and a big bounce. So, it all, to me, looks about the same. And that same is that these markets are going to try to, bounce a little bit more or pull back a little bit more, depending on which one you're looking at. Then you're going to get some sort of a retrace or a bounce back the other way. And it's probably going to do this for a while. I doubt either side is going to break higher or lower in a sustainable way immediately. You've had these huge drops, now big fast bounces. Now you're going to see it just kind of, imagine a ping pong ball where you slam it down and then it bounces real high and then it kind of slows down a little bit and it bounces a little bit lower, a little bit higher, right? That's the sort of thing that probably happens here. Build out a range, and then eventually one side or the other is going to cry uncle and you're going to get a larger move again. Okay, I wanted to take a little bit of time and pull up a chart here on market cycles because, one of the things that we've noticed, and I've talked about it a little bit or hinted at it a little bit already, is that some of these markets certainly look to me that they're doing distribution patterns potentially. Now you never know until the end whether it's distribution or not, but what you do know is that it could be, and that's always the important thing. Just like we knew that we could get a larger sell-off 2 or 3 weeks ago, you can see the storm clouds coming, and you have to recognize that that's what they are. It doesn't mean you have to get up and run for cover when you see them on the horizon, but you definitely need to notice them, right? And that's kind of what these market cycles are and distribution patterns. So, if this is a distribution pattern, it looks something like this. Now, this was taken from a book, The Complete Guide to Volume Price Analysis, Anna Coling. I haven't actually read this book. One of the members of TA Today passed it to me this weekend. And, I've seen these types of charts before. I don't know who originated them. This is one example of it. But what they're really saying here is that, at the bottoms, you accumulate. At the tops, you distribute. And who is doing the accumulating and the distributing? Well, that's the large, multi-million-dollar institutions, even $1 billion in many cases, that take a long time to get what they want. Maybe they have to build a lineup of 20, 30, 40 million shares of something, or of maybe the S&P itself. You can't just go buy that in a day. It takes weeks and months to actually do that. And if it takes that long to do it, you're actually going to see it take that long to get rid of it. Now, if I'm that type of institution, and especially if most institutions are seeing the market the same way, and I suspect that they share notes with each other just like, I share notes with my members. And for people that I trade with, my colleagues, so to speak, a general feeling develops at some point that this is probably the top. And when that feeling develops and that expectation develops, and that's really based on fundamentals in the end, those large operators are going to want to get out of, or certainly reduce greatly, the amount of shares that they have. And how do they do that? Well, what they do is they start, as much as they can, they get the stories to be in their advantage. And Wall Street loves to write positive stories anyway. And so they use that press releases and things like that to try to push the market up while they sell into it. And when the market does fall down, then they're there buying, and they buy, let's say they sold maybe a cumulative total. Institution X sells a total of 4 million shares on the way up here. Now it drops down, and what does he do? He buys maybe 2 million back. And then it goes back up and he distributes another 4 million. And then it comes back down and he buys another 2. So at this point he's gotten rid of 4 million, and maybe he's got 10 to get rid of. So now as it goes back up, he gets rid of 4 more. So at this point, he's gotten rid of almost everything he needs to get rid of. And as it comes back down, maybe he starts buying, and then he sees that it's not going to hold. And instead of buying, he just dumps everything he's got left. Well, that distribution is taking place up here, and then when he dumps, that's what a lot of people call marking the market down. It's a markdown, and that's really those institutions pulling the plug on what they got left, because selling up here is a lot better than selling down here. And if you don't think you can hold it up anymore, that's what you do. Now hold that thought and go over and look again at what we were just talking about with, say, the French CACs. If I pull this back, and let me put it on a monthly and see what it looks like out of curiosity. If I pull this back on a monthly and I look at this, might this be that kind of distribution starting to take place? Might we see, that kind of jagged thing that we just saw? Might this be that kind of action taking place right now? Where the institutions eventually are going to have to give it up, and then this market's going to drop? That could be what's happening. Now, we don't know that. We just know that that could be the case. What does that mean? Well, that means that you don't want to be loading up here unless it really does start to take off again. Because if it's distribution, you don't want to be the one buying. So keep that in mind as you see this market. And this period of time that this takes place, there's no time set here. But markets usually, like I said, they're ocean liners. They don't top out in a day. It takes a while. It takes, if you go back and you look at some of these charts, and I've written about this before, you're certainly welcome to go read the articles that I've written about before. But if I look at, let me pull up the 2000 crash. Now this doesn't show it particularly well, but the market topped in March right here. This was the top of 2000. And this top, this area right here, is like the middle of March, I think, or right at the beginning of March. This distribution that took place here, right, took place over a long period of time. This is February the next year, actually end of the year before it starts to break down, gets that final bounce, and then it's marked down. That was an 8-9 months before you ever saw this thing give it up. Well, fast forward to today, and let's go back. Instead of using the Russell, let's look at, not the Russell, but the Russell shows just like the CACs does here in our markets, although it's just one of our indexes, not all of them. If we go over and we look at, say, the S&P 500, and we look at it on a monthly basis, as I just showed you when we came on top of the air, this is the first trip down. If this is the top, I don't think it's going to happen immediately. I mean, I would expect this range to build out here for some period of time. You're only 4 weeks off the top. So if in fact this is the distribution taking place, you can expect it to take a little while. It's not going to happen immediately. And so I would be looking at this from that perspective. And if you look at the 2007-8 crash, this is 2008. The market topped in September of 2007. When did the crash take place? Well, it really broke down here. Let me see. What time frame do I have? This is 2008. October was the top, and then it came off hard. So your crash really was kind of about right here is when it really started to give it up. Now, it had already traded much higher. I mean, back in March of, not March, but September of 2000, this market, September of 2007, this market was up here, at 15, almost 1600. It may have been over 1600. I don't remember exactly what the numbers were, but it took a year was the point. It took a year before it finally crashed, and more than a year. So it takes a while, and that's the whole point. So if this is distribution, if this market cycles that we see here, if this is what's happening, you can expect it's going to take a while before you get the markdown phase. And this is the phase that you can lose 40-50% of your money. You don't want to be part of that. And so, let's just realize where we could be. Let's keep analyzing where we are, and that way we can keep ourselves out of trouble. Okay? I think that's a pretty good feel for what happened last week. I would expect some sort of a bounce to continue, and I expect probably the next 2, 3, maybe 4 weeks, you're going to see some sort of gyration in a very large range probably as this market builds out a range and then decides what it wants to do. And there's nothing, I've been talking a lot about the kind of a negativity here, but there's nothing to say that this market can't go back and make new highs again. I mean, I would be surprised, but I wouldn't be shocked. If we turn around and say, a few weeks, maybe towards the end of the year, and we come back and we find the S&P trading up here at 2,000 again, maybe even back to the 2020, I wouldn't be surprised. I mean, look at how this is set up. I wouldn't be surprised to see the S&P come back into this area, test this bar and this bar again before this is over. So that range eventually could look like something like that. That's a large, huge range. Initially it's smaller, and that is that you've got half range here, and that's what we're dealing with now. But it certainly can trade back up to that area before this is over. They won't just walk away, folks. It will take a while, even if this is the top. And if the economy really is well, then it's not the top. This is just some distribution that took place, some fear that came in the market before it went marching off north again. And that's also a possibility. That's, this, nothing says this has to be distribution. There's nothing here to tell us that yet. What we have so far is a sell-off. We've seen them before. This is just another example of it, another case of it. Will it turn into something more? You're going to need more information to know that. And that will come. But in the meantime, you have to, figure out how you want to deal with it in your own personal portfolio. I know how we deal with it, but you have to decide how you're dealing with it. And a lot of that has to do with your time frame. What is your time frame? Is it long term? Is it intermediate? Is it short? It's a very different trading strategy for each of those three. Folks, thanks for joining me. I appreciate it. Tell a friend, tell two. I'm LA. This is and was your weekly TA wrap. Have a great one. I'll see you next time. Good night.